Hello beautiful people, it's Keith here from Performante. Today is January 21st, 2021, and in this video we're going to be going over how to generate stable passive income using stablecoins on a variety of chains. We'll split up the video into 3 different sections: low risk at the start, medium risk in the middle, and then high risk stablecoin yield generating strategies at the end of the video. The APRs range from low double digits for the low risk all the way to over 50% annual yields on stables, so be sure to check out the whole video. Sitting on some cash for dip buying opportunities is not a bad idea in our view, and these opportunities allow us to generate income on assets that will not appreciate. And if this is your first time watching, my name is Keith and I'd love to welcome you to Performante community culture. We've created a community of like-minded crypto enthusiasts from all walks of life, sharing trade ideas, new projects, and updates on existing projects, and that's really just scratching the surface. Discord is our home, so if you're interested in crypto, it's definitely the place to be. We've also created a social token called PCC along the journey, and you can earn it all for free right from our Discord. Digital assets and a great community, link is in our bio. And before we dive in, keep in mind that we are not financial advisors. This information is not financial advice. It's really just to consolidate the information into a single video and help with the due diligence process so you can make an informed decision about yield farming stablecoins. Without further ado, let's jump right into the video. The first low-risk opportunity that we have is Anchor Protocol. If you're in the crypto realm at all, you know about the 19.5-20% APY that Anchor Protocol is able to provide. What you may not know is there's actually insurance for the protocol that is able to provide that 19.5%. And we can see the coverage details here for the Anchor USD PEG, the smart contract insurance. And right now, the premium for this insurance is a little over 5% a year. So the yield that we're able to generate, if you count the insurance that would be added to this, would be around 14.3, 14.5% APY, because the insurance premiums is 5.2%. APY for Anchor Protocol is sitting around 19.5, so you're probably able to generate around 14% APY for this low-risk stablecoin yield. The next opportunity we'll look at to generate yield on stablecoins is something called yield aggregates, and what this allows us to do is look for different liquidity pools on different exchanges all over a certain chain. So this is, for example, on the Avalanche, and this particular platform is called YieldYak, and it's a yield aggregate that allows us to find the best yields for whatever token or asset that we are looking to yield. And in this particular example, we're taking a look at stablecoins. And this is different from the DEXs that we'll take a look at that is yielding a higher APY. And the reason is we are basically participating in 2 different automated market makers where we are providing liquidity to a certain trading pair, and the transaction fees occurred in that trading pair is paid out to the yield providers, which is you and me, if you're actually going to be putting money and capital within these opportunities. The difference with the DEXs that we'll take a look at that has higher APYs is they are paying out in their native token, so they could pay out a higher percentage because they could just basically create the tokens out of thin air that they're paying out. So the percentage in those particular LPs are a lot higher because they're able to just create them out of thin air and pay them out. But the downside is you get paid out, for example, if you're on Spirit Swap, in Spirit, which is their native token, and usually DEX tokens are inflationary or hyperinflationary because they pay out such high APYs, so then they're able to generate more liquidity because there's more incentivized reasons for people to enter that particular swap because of the high APYs, and this creates downward sell pressure on the actual asset that you're getting paid out in. So if you are able to if you're able to compound them manually, that's great, but it does incur high transaction fees. But if you wait in order to actually compound, the asset that you are getting paid in or rewarded in is decreasing. So it creates a difficult situation for the liquidity provider where they're either going to incur high transaction fees because they're manually compounding the reward that they're getting paid in, or they are getting paid in a certain amount or getting a certain amount paid to them, but they're actually auto compound or compounding less than what is initially getting paid out because the asset asset that they're getting paid out in is decreasing over time because everyone's getting paid in that asset and everyone is selling that asset to compound into whatever they are yielding. So it's kind of an unfortunate thing with the DEXs that we'll take a look at that has the higher APYs. So these are the particular yields that get paid out in the principal or the asset that you're actually depositing. So the first thing that we'll take a look at is a DAI. It's on Banky, and we can see this strategy repeatedly lends borrow DAI on DAI. Basically, you get paid DAI and you earn DAI on Banky, which is a particular DEX there. And what this is different to compared to the DEXs that we'll take a look at after is what you earn. So we can see in this particular yield farm, you deposit DAI, but you earn DAI. So there is no need to sell a particular native token and buy back DAI and then compound it into your LP. There's none of that auto compounds, so that's really nice to see. And this particular APY is 11%. This one is Magic Internet Money from Abracadabra, and this is APY is 12%, and you deposit MIM and earn MIM, and this is on Banker Joe. And the final one we'll take a look at is USDC, DAI, and MIM put together in 3, basically to create a unit of 33% in a particular LP. And this one is on AM3D, is an LP token that earns swaps subject to impermanent loss, uses the following assets. And it's on Axial, we can see that right here. And it is APY is 15%, which is pretty solid. It's not going to compare to the Anchor protocol, but it still does provide a pretty decent APY when you're looking at it from the traditional markets. If you're looking at like the average return of the S&P 500, you're basically beating it holding cash. To some degree, you do have some risk involved, like smart contract risk, all that stuff. But at the end of the day, you do have a pretty solid return with very little downside risk. Now, before jumping into the liquidity pools on the DEXs that we'll take a look at, just want to go over the difference that we saw versus the liquidity pools here, where you're getting paid in the asset that you're depositing. Like, for example, on the MIM, you deposit MIM and earn MIM. Let's say, for example, we're just going to be taking a look at this particular liquidity pool first. We get paid in Cake. Spirit Swap, you get paid in Spirit. So it's just something to keep in mind. And Orca, which we'll be taking a look at last, we get also paid in Orca. So definitely something to keep in mind when you are yielding the higher APRs or APYs. The next medium risk opportunities for stablecoins is utilizing the liquidity pools on DEXs or decentralized exchanges. We can see here on PancakeSwap, there are different trading pairs, as you can see with all other DEXs, and some trading pairs are stable on stable, so there's no chance of impermanent loss, and your assets, because you have to split them up evenly within the liquidity pool, are going to be held in stable coins. So the actual principal or the underlying asset that you're holding is stable, which is fantastic, and then you're generating revenue from the trading fees that are incurred by the traders swapping for UST to BUSD or vice versa, BUSD to UST. And that's how you're able to generate the income, by providing liquidity to decentralized exchanges. And we'll take a look at a bunch of different chains. The first one that we're going to be taking a look at is PancakeSwap on the Binance Smart Chain. And we can see UST, which is the Terra Luna stablecoin for US dollar, with the Binance stablecoin BUSD is earning an APR of around 12.24%. The current liquidity is over 15 million, so there's a lot of capital in this particular trading pair. The next one that we're going to be taking a look at is on Trader Joe. This is for the AVAX network, and we can see USDCE and USDC, basically the exact same stablecoin for this liquidity pool, is generating 24% APR. The next DEX that we're going to be looking at is on SpookySwap. This is a Phantom Network DEX, and USDT TUSD is generating around 12.8% APR, correct. And then also on Phantom Network, this is Spirit Swap, and the MIM, which is Magic Internet Money from Abracadabra, and then USDC, Coinbase's stablecoin, is generating at this liquidity pool here an APR of 21%, just under 20%. The final one, this is going to be on the Solana network. This is on the Orca DEX. We can see that the wrapped UST and USDC liquidity pool here is generating an APR of 26%. A lot less in terms of total liquidity provided, but still APR of plus 20% is really high for stablecoin liquidity pools. The final part of the video is for the high risk, high reward opportunities for stablecoins. And the first one I've been able to identify is from Platypus Finance. This particular opportunity requires the user to hold a risk on asset, Platypus token PTP, so definitely something to keep in mind. This particular opportunity allows us to have a normal yield, let's say for Magic Internet Money or DAI, and we can see the base reward for APR is 8% for both here, for DAI and MIM, but if we get the average boosted APR, it jumps to 49% or 52% for the APRs for both the stablecoins. And how we're able to receive the boosted APR is by staking its native token, PTP. So if you stake PTP, you get the boosted yield for the stables, and that's how you're able to generate the 52% on MIM and 50% on DAI. So you're probably thinking, okay, so if I have to stake PTP, I have to understand what the risks are for it, because there is a coverage ratio, meaning you have to have a certain amount of PTP in order to actually redeem the boosted APR. And we can see it is pretty volatile. It went from sub $2 to $16 back to $5. So this would be primarily for a bull run if you want to keep some cash on reserves in case there is a dip. But if it's a bear market, if there is some fear, uncertainty within the markets, in the broader markets, I would be very hesitant to utilize this particular opportunity, because if the coverage ratio goes below a certain amount, you don't have enough collateral in order to make sense of the boosted APR, because the PTP is going down so much. So then you could potentially get liquidated, or you could get kicked out of the boosted APR for stables. So if PTP is going up, great opportunity. If PTP is going down, be very careful. Keep a really close eye on the price of PTP, because if it goes against you, it could be pretty negative or pretty detrimental. So definitely a higher risk, higher reward opportunity if you are bullish on PTP. The final opportunity for yield farming stablecoins is on Abracadabra Money. If you don't know about this, you could basically collateralize certain assets and borrow MIM, which is also a stablecoin. And in this particular opportunity, you could collateralize a stablecoin to get another stablecoin. So there's some risks involved. We'll go over it, but in short, how this operation works is, let's say you first need to get UST. How you would get that is you go to somewhere like SushiSwap. You could swap, let's say, Ethereum, like so. You could wrap, this is the wrong one because I have Sushi right here and I'm on AVAX. So we just switch to Ethereum. Quickly switch the network here. So we're going to swap from Ethereum to, let's say we want to go to UST. Like so. So we would put in Ethereum, we would swap it to USD. Once we have a certain amount of USD that we're looking to collateralize, we would then go into Abracadabra Money, collateralize the USD that we just swapped into, and then receive Magic Internet Money, which is also a stablecoin. What happens after is the collateralized UST then enters the Anchor protocol, which is this one right here. And this is able to generate what we call AUST. And this is the asset that is generating the 19.56. So when you actually collateralize UST, you do get some APY. Now, keep in mind, it is less than the Anchor protocol APY, because this is 16.5. Anchor protocol APY is 19.5. And the reason is, Abracadabra Money does keep a little bit of its collateral in case someone needs to sell. They don't switch it to AUSD immediately. They do keep some USD, but that's how it's able to generate the APY just by collateralizing USD for MIM. Is you get the 16.5% APY because Abracadabra Money instantly switches some of its UST over to AUST, which is the interest-bearing asset that Anchor Protocol is able to generate. Once you collateralize UST, you'll get a certain amount of Magic Internet Money back, and the amount that you get back is dependent on what you press here. So this percentage here, 25%, 50%, 70%, 90%, this is the amount you are able to receive as a reward relative to the collateralized amount. So let's say, for example, I put in $100 UST here. Let's say if I press 70, what this means is I collateralize $100, I get 70 MIM back, so then I get a 70% collateralized ratio or a loan to value ratio. If you put $100 in UST in the deposit and you get $50, $100 of collateral, $50 of borrow, that would be a loan to value ratio of 50%. So the higher the number, the riskier the amount, because you don't have a whole lot of collateral for the amount that you have borrowed. So a good way to understand what a safe amount to borrow would be is to look at the Terra USD value. We can see that although it is pegged to the US dollar, it doesn't always hold its peg. Like the most aggressive day that we had a disconnection between the US dollar and Terra USD was on, let's take a look here, December 29th, 2020, when the peg completely dropped down to 0.85. So it dropped 15% from the peg, which is definitely something to consider when you are collateralizing your UST for MIM. And the reason is there is a liquidation price. So if it goes below a certain threshold, it will liquidate you. And although you'll get to keep your MIM, all the UST that you collateralized will vanish. You will no longer be able to redeem it again because you got liquidated. So although you get to keep this, the value of the UST that you put in as collateral went below the borrow MIM amount. So then you got liquidated. You get to keep your MIM, but you don't get your UST anymore if it does liquidate. So definitely keep that in mind. And the way that you're able to kind of understand what a safe range would be to look at the liquidation price maximum. So if you say 70%, you're giving yourself 30% window either to the upside or downside, mainly to the downside, for your safety net, basically. So if you have a liquidation price, let's say of 70%, you could take on 30% of risk to the downside on UST. So if you're looking at this is a max of, let's say, 15%. So you'd be totally fine in terms of the potential liquidation price if we do get something as drastic as we had back in the late 2020 era. So because we can see the maximum was 15%, we could do probably a custom of, let's say, 80%, I think would be a safe side, or 75% would be a safe side, meaning if we put in $100 of UST here, we'll be able to generate $75 of MIM. And what we do is then we would exchange that MIM for UST on a DEX, and then we would deposit that UST again, generate MIM, and just loop over and over. And this is the looping strategy that we're able to generate through Abracadabra money. So we can see this little GIF here as a representation for the leverage. This is the amount of times we're going to loop, or the amount of times we're going to deposit UST into Abracadabra money. We're going to receive MIM. We're going to buy UST on the open market. We're going to transfer that UST into MIM, and it's going to be a loop. So 2x is 1 loop, 3x is 3 loops, and we can see the collateral has to decrease by a certain percentage for you to get flagged for liquidation, and the higher the percentage, the more safe it is. And I just took 2 screenshots here. We can see at a loop, or a looping of just under 2, 1.85 times expected leverage, we see an average APY, or an expected APY, of 42 or 43%, and we have 27% decrease needed in order to get a liquidation, which is very, very safe. Because if we look at the Terra Luna stablecoin, the max that went down was around 15%, 0.85 cents, so around 15%. So if we're under the 20% mark, that should be enough buffer that we should not get liquidated, and we're just able to generate this stablecoin APY without really having to worry. So 27% is definitely on the much safer side. I'd go a little bit more, like maybe 2x in terms of the expected leverage. Now we can see a 3.71 expected leverage with an expected APY of almost 70%, but we can see here the price of the collateral has to decrease approximately 10% for you to get flagged for liquidation. So the UST only needs to drop 10% in order for us to get liquidated, and it's a 70% APY. If we go back to Terra Luna, this drop right here would have liquidated us, so we want to be a little bit more conservative. This is the high risk, high reward pool, so you could play in the 10% range and generate a 69% APY, but if UST does drop below 80 cents, or actually 90 cents with this particular strategy, it would completely liquidate you. So having a 20%-ish for the drop in collateral, I think would be a safe bet when you are playing with Abracadabra money. So that's going to be the overall view of my stablecoin yield farming strategy, from low risk, low reward, medium risk, medium reward, and high risk, high reward. So that sums up our stablecoin yield farming strategy. Thank you very much for tuning in. If you found this video to be useful, educational, entertaining, it would mean a lot if you do hit that thumbs up button, and please subscribe so we know that we should continue making more videos like this. If you haven't, definitely join our Discord. We go over strategies like stablecoin yield farming or yield farming on normal like L1s or L2s as well. So if you don't have a community, or if you're looking for a community that is friendly, that's able to bounce ideas off of you or present new ideas, definitely check that out. Link is in our bio below. With that said, I hope everyone has a great January 21st. And until next time, have a good one, traders.